Jim is continues to be a very important part of how I shape my narratives in the market. Reading his work, is one of the best guys I know at marrying up his insights on the Fed. He kept people aware that the Fed was going to be more aggressive than the markets had anticipated. So the move in rates hasn't been that surprising to him, and the bear market hasn't been surprising to him. So pay attention. It's really not going to be an interview because Jim has gone through a lot of effort to prepare a presentation of what he sees coming. So what I always say is keep an open mind. It will keep your account open. And so, like, Jim,
very good advice.
Yeah, so I'm not going to be interrupting with my questions. I'm going to just let you roll with what you have for us today.
Well,
and then I'll come back at the end.
All right, buddy. Thank you for that introduction. I want to say thank you to all those who are attending and tuning in 45 minutes. You're going to be glad that you did. All right, the intersection of monetary policy, economic fundamentals, and technical analysis. What does that really mean? Well, I'm going to go back over the last year and cover some of the ground that I wrote about, as well as doing videos with Blake Morrow every single week. So a lot of this information Blake and I discussed as 2022 was progressing. So as you might remember, back in November of 2021, Jay Powell said that inflation wouldn't be transitory. And to me, what that meant that the Fed was going to be shifting policy from extreme accommodation toward tightening. So in the December macro tides, my expectation was that as that unfolded, the S&P would drop by 10% or more, which of course is exactly what happened. On January 12th, Jay Powell said that inflation was a severe threat. So, think about it. If you and I are, facing a severe threat, do you react quickly and strongly, or do you kind of go walking casually away from the threat? No, you move aggressively. So on January 17th, in my weekly technical review, I said that I thought the Fed would front load the rate increases by raising the funds rate March, May, and June, which exactly what happened. But complete counterpoint to Wall Street. They were looking for 3 rate increases in all of 2022. In terms of the economy, Jay Powell started the transitory theme in June of 2021. And in June, July, August, and the following months, I went through great lengths to explain why inflation wasn't going to be transitory. As the Fed was going to be shifting policy, technically, the dollar looked like it was near a trading low in June of 2021. My expectation was as the Fed moved toward tightening policy, we would see the dollar rally from 90 to 103, which was the January 2017 high. As you might remember, in late July, the Commerce Department came out and said, yep, second quarter GDP was down 0.9%. That followed a 1.6% contraction in the first quarter. Everybody immediately said, oh my gosh, the economy's in a recession. I went through great lengths. Blake and I talked about this week after week as to why the economy wasn't in a recession. Time doesn't allow me to go through all those points today. But the conclusion was that with Wall Street expecting that we were in a recession, that meant that they were expecting the Fed to raise rates and then quickly bring them down. And my take was, no, that's not going to happen. And when Jay Powell did his 8-minute Jackson Hole speech, he pushed against that quite hard. The S&P dropped from 4,300 to, I think, under 3,700. From a technical standpoint, in April, my expectation was that the market was near a high and that as the Fed shifted to a more aggressive policy, that the S&P was likely to at least retrace 38% of the rally from 2192 in March 2020 to the January 2018 or 2022 high at 4818, and that came in at 3815 to be precise I was thinking that the S&P could get down to 38.50. It got to 38.10 in May. In mid-September, I felt that the Fed was going to continue to follow through on their comments, that the 50% retracement was likely, which was 35.05. The S&P subsequently dropped to 34.92. So the point being is there are very few people that combine an analysis of monetary policy, economic fundamentals, and technical analysis. I do it at a very high level. Now, that said, I have to also tell you that I'm Irish. So Murphy and I are really well acquainted. So over the last 40 years, besides accumulating a lot of experience and knowledge, I've also made more than my fair share of mistakes. So I've, kind of been forced, if you will, to learn from those mistakes. Here's something that I learned that I think is really important. So every day on CNBC, we hear people talking about the market discounts the future. It's forward looking. Yes, it is forward looking. It's looking out 6 to 12 months. But just because it's looking out to 6 to 12 months doesn't mean the vision is good and clear. So, this January, the S&P got to 48.18. What was it telling us at that point in time? That there would be no problem with inflation and monetary policy? Or in October 2007, made a new all-time high? Oh yeah, it was telling us there would be no financial crisis and the subprime mortgage problem was going to be contained. So why do people believe that markets discount the future? Well, if you think about it, as the economy emerges out of a recession, there's a window of time where the Fed is either neutral or accommodative, and the economy is growing, earnings are growing, the S&P is going up. And as that continues month after month, year, 2 years, 3 years, people then begin to project that that's going to just keep on going. So when they get to a fork in the road and a curve like this last January, they're still thinking the economy is going to be okay, earnings are going to be okay, and the net result is that at turning points, markets are always wrong. And it doesn't matter what the market is. As I've noted, treasury yields, gold, look at the housing market in 2006. Everybody thought prices were going to keep going up. So my point is that most people believe in this idea that markets discount the future. And for a long time, I held on to it too, because everyone else is saying it. So I want to be savvy. Well, markets discount the future. My point is, think about that, challenge yourself, because I think what you'll find is more often than not, that is not the case. So why believe in something that is typically wrong at tops and bottoms? As an antidote to that, I use contrary opinion. In other words, when everyone's bullish, I want to start looking at what are the cracks in the narrative, and then technically be able to see signs that things are starting to run out of gas. So in January, when the S&P made a new all-time high, one of the indicators I follow and use is the advanced decline line. It made a lower peak relative to its peak in early November. Same thing happened in 2007. So that suggested that underneath the surface, there was more weakness. So I use contrary opinion along with a lot of technical stuff, and it's proven to be really helpful. I'm going to give you a more recent example. So in November of last year, Powell says inflation is not going to be transitory. The CPI hit a 39-year high. Here is the December 9th Fed futures. And what you can see in the left part is when the probability was that the Fed would be raising the funds rate a quarter of a point, and so forth. So the Fed funds future on December 9th, armed with the knowledge that inflation is not transitory, and that inflation was at a 39-year high, only was looking at 3 rate increases. So that cartoon to me summarizes it best. Oh yeah, market discounts everything. And if I'm wrong, hey, it discounted that too. So, as I said, January 17th, I felt that the Fed would front load rate increases by going in March, May, and June. So let's go. All right. So the Fed has repeatedly said it wants to avoid the 1970s mistakes. Well, what were those mistakes? So this is a chart showing the federal funds rate, which is in red, and the core consumer price index, which is in blue. And what you can see is in the mid 60s, all of a sudden, inflation started to ramp up and the Fed tightened pretty aggressively. It led to a recession in 1970. The Fed immediately reversed course, brought rates down, the economy recovered, and lo and behold, inflation then moved up and was higher in 1974. The Fed jammed on the brakes, raised interest rates. We went into a recession. The Fed lowered rates. Immediately, inflation ramped up again in the latter part of the 1970s. So what the Fed wants to avoid doing is stepping on the brake too hard so that it forces them to do a 180 and ease policy. They believe, and I think they're correct in this aspect, that if they raise rates to a restrictive level and hold it there for an extended period of time, the economy will slow more gradually as opposed to abruptly, and that gradually inflation will come out and they're going to get what they're hoping to accomplish, which is to bring the Fed fund or inflation down to about 2%. So I don't think markets fully have digested this difference. That second part, hike and then hold at a long time, I think is going to be another issue that causes the stock market some trouble in coming months. All right, so everyone knows these. Fed wants to bring inflation down to 2%, unwind labor market tightness. But as I wrote back in November, the Fed can't do anything about oil. It can't do about labor market. They can't all of a sudden have a bunch of workers show up and food prices and so forth. So the only thing they can attack is demand, and they're doing it by raising interest rates. And so to me, that's somewhat problematic and inefficient, but yet that's what they're hoping to accomplish. Okay, so the CPI. The way the CPI is calculated is a 12-month rate of change. So every month they subtract, so coming this October, they're going to subtract whatever the monthly increase was in October of 2021. It was 0.87%. And then they're going to add whatever the inflation rate it was during this past month, October, of this year. So what you can see is the numbers get pretty big over the next 6 months through March with a huge 1.24%. So the table on the right basically looks and says, all right, if inflation goes up 0.3% every single month, and I think in the near term, it might go up a little bit more than that. But again, if it goes up by 0.4 and you subtract 0.87, guess what? The CPI is going to drop by 40 basis points. So what the far right column in that table shows is that by March, even if inflation goes up 0.3% every single month, the year-over-year inflation rate is going to be down to 5.1%. And if it only goes up 0.2% every month, it's at 4.41%. The Fed knows this, but they need the numbers to start to show up to kind of give them some maneuvering room. So my point is, this past week, the Fed funds futures got up to a 5% handle for April. Now, if inflation is coming down the way it looks like it's going to in the first quarter, does anyone think that the Fed's going to 5%? I don't. So that's key. All right. Powell has talked about labor market tightness. And basically, one of the things he cited repeatedly is looking at job openings in the JOLTS survey. So, for months, there was like 11 million plus job openings and about 5.5 million unemployed workers. And that ratio was 2 to 1. The last month, which this is always reported with a 1 month lag. So this would have been August. It dropped from 11 million to 10 million. Nice decline, right? So the ratio now is 1.7. He thinks if he can get the ratio down to 1.0, that will, work towards solving a good chunk of the labor market tightness. I'm not completely convinced about that. If you look, you can see below that horizontal black line, in 2017 and 18, the JOLTS ratio to unemployed went from 0.8 to 1.2. So, and wages during that window of time were going up. So my point is, we're going to see this come down. This is the way it works. You're a businessman, you're running a company, you've been having great difficulty hiring workers. So what do you do? The first sign that the economy might be slowing? Well, instead of looking for 10 new workers in the next 12 months, you cut it in half. And then if the economy slows a little bit more, you cut it a little bit more. And when you start to see your business being impacted by a slowdown in the economy, you don't let people go that you work so hard to get and begin to train. You cut hours. So that's why the unemployment rate is a lagging indicator. It won't really start to move meaningfully for probably another 6 to 9, maybe even 12 months. I mean, you'll see some small upticks. So the point being is that, after such a hard time getting good employees, employers are not going to be quick to let them go. So this is the projections that the Fed released after their September 21st meeting. And you can look and see that they think the unemployment rate, which is the second item on the left in the little table, at 4.4% in 2023 and 4.4% in 2024. I think the Fed is delusional. But at the same time, I think it underscores that they're hoping, if at all possible, to either have a soft landing or a very shallow recession. Because what Powell and the Fed is saying here is, okay, we get the JOLT survey down to 1.0, and that's going to help us and go a long way to easing labor market tightness and starting to moderate wage growth. So that, to me, is what that message is giving. So I went back to 1953 and I looked at every business cycle. What was the low in the CPI, and how much did unemployment rise from that low, from its low to its high? The average increase was 3.6%. Now, some of those were pretty big in the mid 70s. So if I looked at the smallest one, it was 2.1%. All right, well, we just had the unemployment rate hang around 3.5. 2.1, we're at 5.6%. So that's why I think the unemployment rate is likely and will need to go above 5%, later on next year and into 2024 to really bring, relief, if you will, to the labor market tightness and, moderate wage growth. So the question is, has the stock market priced that in at this point in time, a 5% plus unemployment rate? I don't think so. All right, one of the challenges is maybe this labor market tightness isn't just a cyclical thing surrounding around COVID. Hey, the government said, put $6 trillion to work. People received a whole bunch of money. They went out and bought a lot of stuff, caused the demand for goods to skyrocket. And now we're seeing the demand for services start to go up. What if this isn't just a cyclical problem, but more of a chronic problem? And I think that is very likely. This is the labor participation rate. So they look in between the ages of 15 and 54 or 16 and 54, what percentage of that group is actually working? And what we can see is in 2001, it peaked, and it's been in a 20-year downtrend. So what that says to me is, for whatever the reasons, and there are some additional reasons going on right now, you had early retirements by baby boomers, close to almost 2 million people. Some of them are coming back to work because inflation is so high, they're getting worried about making ends meet. Women out of the labor force, either taking care of somebody with long COVID. Long COVID is another problem. Guesstimates are like 500,000 workers are out of the labor force and so forth. But irrespective of those specific reasons with COVID, we can see that the labor participation rate has been dropping for 20 years. So what this says to me is that the drop in the JOLT survey that Powell's hoping is going to provide a lot of relief for labor market tightness. I don't think it's going to generate as much help as he's thinking. And the net result is we're going to need to see the unemployment rate work its way higher. So forward guidance. This is a huge thing. Since the financial crisis, the Federal Reserve has leaned more heavily on forward guidance as part of their policy. And it's understandable. When interest rates are at zero, and they were going to stay at zero for a long time, what do you tell people about policy? So more and more they got into, we're going to let everybody know. And the idea being is that if we let everybody know what's coming, we're going to subdue volatility in the financial markets. And that's a good thing. All right. There's three problems with that, though. David Rosenberg went back and looked at the accuracy of the Fed's projections that we just looked at a couple minutes ago. And, when you think about it, the Fed has no real control over GDP, the unemployment rate, and core inflation. I mean, there's other dynamics at work beyond their control, but they have total control over the federal funds rate and where that is going, whether up or down. And what he found is that their projections of where the federal funds rate would be were accurate only 37% of the time. And the other were worse in terms of where the economy was going, unemployment and inflation. So my point is, if you're going to go through all this effort to guide markets with your estimates and so forth, and also use all that work, the Fed has like 200 PhDs, but they're it hasn't been working out real well. So my point is, they're actually giving bad information. Markets are believing them. And then the Fed turns out to be wrong more than 60% of the time. So here's the three problems. Forward guidance is wrong. Just covered it 60% of the time. Then there's also the instances where the markets don't listen. Even if the Fed speaks very, very clearly, markets don't listen. So look back this year. The Fed was saying, we're going to raise the funds rate to the neutral rate, which was basically around 2.5%, as expeditiously as possible. Markets didn't believe the Fed was actually going to do that. And the net result, the S&P dropped from 4,600 in late March to 3,600 in June. Why? Well, I've thought about this a lot. And so if you've been on Wall Street for 25, 30 years, you have a lot of experience. But you've never experienced a 40-year high in inflation and the monetary policy necessary to address it. So their experience has been the last 20 years, the Fed has shifted policy to accommodation whenever trouble has shown up. But the reason why they were able to move aggressively in those instances is because inflation for the last 20 years, as measured by the core CPI, has been hanging around 2% to 2.5% for that whole window of time. So that's why the Fed was able to do that. With core inflation at over 6%, the CPI headline had, got 9.1 in June. The Fed doesn't have that wiggle room. That means they have to follow through on what they're saying. And I think that's why Wall Street has consistently got it wrong. So again, after the second quarter GDP report, we're in a recession, the Fed's going to raise rates, but then they're going to bring it down early next year. And in Jackson Hole speech, Powell said, no, we're not going to do that. So this is the problem that I think the market in Wall Street is dealing with. I think another shoe is going to drop. I think there's a recession coming next year. Despite everything that's happened, earnings are still expected to grow for 2023. I don't think that's going to happen. So at some point in time, we are going to see more signs that the economy is really slowing down. And we're going to get to that in a second. And as that happens, I think the market's going to stumble because the Fed, even though we get more signs that the economy is slowing, the Fed, if it can, in other words, you don't go into a really sharp decline in the economy, the Fed's going to hold the funds rate at a high level, a restrictive level, at least what they're intending to do, all of next year. And I don't think the Wall Street and those who are calculating earnings have fully gotten that into mind. So what we've had is, oh my God, I think the Fed's going to pivot. Fed's going to pivot. And all that's based on, they've been around for 25, 30 years, but they don't fully comprehend what a 40-year high in inflation is and what the monetary policy needs to be to bring it down. Third problem, inflexibility. So they always want to guide the markets. So last year, month after month, from June on, inflation is going to be transitory. Every speech by an FOMC member, inflation is going to be transitory. Finally, in November, Powell says, no, it's not going to be transitory. But instead of like shifting on a dime, the Fed continued to buy mortgage-backed paper and treasury bonds for another 5 months because they were worried about generating a taper tantrum, which is what happened back in May of 2013 when Bernanke said, yeah, we're going to start tapering our balance sheet, and treasury yields went nuts. So they wanted to avoid that. But again, what they did is they dug a bigger hole because they got way behind the curve in terms of, stopping buying paper and raising interest rates. The same thing in my mind is happening now. The Fed has laid out this course of, okay, because they're trying to convince everybody, we're serious. We have great resolve. We're going to do this. We're going to do what's necessary, even at the risk of going into a recession, to bring inflation down. So they've penciled out, we're going to go to 4.4 in the funds rate by the end of this year, 4.6% by March of next year, and we're going to hold it. And so they're kind of locked into that. And the only way they get out of that is if they start to see inflation starting to come down. So right now they've kind of trapped in, we got to keep doing what we're doing. Now, what I wrote in this last week, October 17th and October 14th, Blake and I did our usual Friday weekly video. And at that time, I noted that I thought that sometime after the November 2nd meeting, we would see the Fed start to kind of put out some hints that they will discuss, meaning they'll strongly consider doing 50 basis points in December rather than 75. But until they really get some more help from inflation, that's it. So again, the September meeting, they wanted to make their point. We're going to raise the funds rate to a modestly restrictive level, and then we're holding it there. So, that little orange line is a little deceiving because it makes it look like mid-year. But basically, the Fed said, yeah, we're going to keep the funds rate at 4.6 all through 2023, and then bring it down to 3.9 by the end of 2024. The other thing I'll point out to you, there's 19 people on the FOMC, 12 Fed presidents and 7 members of the Board of Governors. Over time, they typically offer different views and opinions about, should policy be this, should policy be that? But over the last 4 or 5 months, they've been speaking with one voice. So you've got Bullard from St. Louis. He's a hawk. I think we should go 75. We should go 75. And then you've got Kashkari from Minneapolis, who's a dove. I think we should go 75. Go 75. So they've really tried to make sure that everyone's messaging is the same to make their point. The dots are doing the same thing. You can see for 2022 and 2023, the dots are pretty bunched. That's unusual. The dots usually look more like 2024 and 2025. In other words, a huge dispersion between opinion. So what's going to happen in coming months is those dots are going to start to widen out as the Fed starts to communicate that, okay, we're going to get to a place where we're going to shift from 75 basis point increase to 50, then maybe 25, to we're going to stop raising rates and we're going to take a look around. So as I mentioned, Blake and I did a thing on October 14th. I wrote about it on the 17th. That the Fed would likely, after November 2nd, start to signal that, hey, we're open to maybe not do 75 in December. Now, financial conditions are determined by treasury yields. So if treasury yields go up, that tightens financial conditions. The dollar goes up, tightens financial conditions. Stock market goes down, tightens financial conditions. The spread between short-term rates and long-term rates, if it narrows or gets negative, tightens financial conditions. So what's happened is over the last handful of weeks, all those components tightened more and more. So the Fed has a blackout window of 10 days prior to a meeting, which meant that the last time anything publicly could be said was Friday. So not really being able to do a whole lot of talking because the FOMC members are booked for speeches and interviews in advance. The Fed went so far as to contact a Wall Street reporter who they've used before to kind of say, well, the Fed's thinking about such and such. And so on Friday morning, there was a report by the Wall Street reporter. Well, the Fed's going to start to debate whether they should go 75. And he, had a quote from Meister, we got to keep going, and a quote from Daly and the guy from Chicago, Evans. We got to stop and consider. Now, what put this in my mind was on October 10th, Lyle Brannard, who is the vice chair, so she's second in command to Powell. Therefore, she exerts more influence than, if you will, the district Fed presidents. She made 3 points. Okay, we all know the monetary policy acts would lag 6 to 12 months. So her comment was the moderation in demand due to monetary policy tightening is only partly realized so far. Think about it. The Fed is effectively driving a car, looking through the rearview mirror at economic data from 6 months ago. So if everything is just moving along fine, no problem. But the Fed has hiked the funds rate from 0 to 3%. It's going to be 3.75 after November 2nd. That's a tremendous amount of tightening and rate increases in a really short period of time. So the lag effect could be more pronounced because of the rapidity that they raised rates. So what she's calling attention to is like, maybe we need to slow down here. All right. Central banks around the world have been following the Fed. And so her point was the combined effect of concurrent global tightening is larger than the sum of its parts. So you have 20, 30 central banks that have been raising rates. And you add up all those basis points. And what she's saying is you can add all those basis points, but the degree of tightening is something greater than that on the global economy. And finally, she said, liquidity is a little fragile in core markets. Think about what's going on in the currency market this year, the volatility. When there's a little less liquidity, price gets amplified. In the treasury market, this is the biggest decline or fourth biggest decline since like 1740 or something, right? So what's happening is in the treasury market, somebody wants to buy $100 million worth of a specific treasury bond. Well, how much does it move? What's the spread between the bid and ask? As it widens out, it's a reflection of lack of liquidity. What you can see is that chart underneath, liquidity in the treasury market is as bad as it was in March 2020 and way worse than any other time prior to that. So if there's any market that's a core market, it's treasury, the treasury market. So, the point being is that she, in my mind, was saying, okay, these are the seeds that I'm planting that will be discussed at some point in time in the future. I thought they would wait to after November 2nd, but because of the rapidity and the tightening of financial conditions, the Fed actually thought it was necessary to have a reporter in the Wall Street Journal kind of say, well, we may not go quite that far. All right. Mary Daly, San Francisco Fed, well, I'm thinking about it. She gave a speech yesterday. Okay, recession next year. Everyone looks at the yield curve. Fine, it works pretty well. My problem is it has a lead time of 19 months. That's like forever, right? The leading economic indicator, the thing I like about it, it's 10 components. So it's broad. It also includes the yield curve, a bunch of labor market statistics as well. And it has a lead time of 10 months. But if using a 6-month rate of change, the lead time drops to 6.7. It turned negative in August, got even more in September. So what we're seeing in my mind is this is saying, okay, 7 months from now, we're likely to be in a recession. Where does that get us? By the middle of next year. Okay, so let's go into some markets here. The dollar. What's happening around the world since all commodities are traded in dollars, as the dollar goes up and other currencies go down, those countries that need to import food and oil, they're paying more. So oil's up 10%, their currency's down 10%. It's costing them 20% more to import whatever it is. So their central banks, because inflation, that's feeding from inflation. In some of these countries, energy and food comprises 40 to 50% of the average household's budget in the poorer countries. So central banks overseas, the emerging markets started raising rates last year. They've continued this year. So in effect, the Fed is exporting inflation with the strong dollar and the weaker currencies. So the Fed is always going to put the domestic economy as the first priority. But I can't help but believe that other central banks haven't been in the Fed's ear saying, hey, man, you're killing us here. because they've been using reserves to try to sell dollars or buy their own currency to slow the descent. Dollar strength sometimes, dollar strength. Well, that's true, but it's also true, especially in times when other economies are going through a tough time. So European Union, it will be in a recession, all right? Great Britain, they're going to have a recession. The Japanese central bank, their extraordinary monetary combination, are all contributing to weakness in those currencies, which is making it look like the dollar is really strong. So it's a combination of factors. So technically, I think there was a cover on Barron's a couple of weeks ago, a headline cover about the dollar strength and how to play for it and all the rest of it. Typically, magazine covers happen near the end of a trend. In other words, the trend's been going on for quite a while. So the dollar's been going up for 15, 16 months. Now it's on the cover of Barron's. It's a sign that we're getting near. Like I said, contrary opinion. That is a signal of, all right, it's time to start looking for things to shift. Well, I believe the Fed is approaching the time when they're going to downshift from 75 to 50, ultimately getting to where they pause. That, I think, will lead to more weakness in the dollar. Technically, the dollar has to take out 110 and close below that. In the meantime, there's nothing to say that the rally off of 110 isn't 1, 2. We just had a little ABC on Friday, and then it's going to go up towards 116 or so. So that has implications, I think, for all the markets. Now, if I'm right about what I think is coming with Fed policy and everything, once the dollar hits a peak, I think we're going to have a pretty meaningful pullback. 104, 105, it's coming, but we need to see the shift in policy. Just as the shift toward tightening began, is my view, back in June of 2021, we're going to see that unwind next year. Okay, so S&P, I think in the near term, my expectation was that we'd see a rally that would get above 3807, have a pullback, and then make a move towards 4050, where the blue trend line, the downtrend from the January peak, the April high, the mid-August high. But I believe we're in a bear market. So we're going to get a little relief as the Fed maybe signals that, okay, things are going to unwind a little bit. In the short term, the Fed's in the blackout period. They're not going to get much fodder. I think there's a chance at the November 2nd meeting, because the Fed's struggling. How do we say that we're going to downshift without causing the stock market to go crazy? That's one of the reasons why Powell's speech in Jackson Hole was so direct and so brief. He wanted to basically disabuse people that the Fed was anywhere near a pivot, and he did. I think there's a chance that he uses that November 2nd meeting. Every meeting we're going to continue to look at incoming data, make decisions at that time. But so anyway, I just think we're going to see choppiness, and ultimately, I don't think the market has made the ultimate low. In terms of Treasury yields, Treasury bonds have gone down for 12 weeks in a row. That's the longest since they started trading the long bond in 1977. The increase in the 10-year, it's up 71% in what, 3 months, 2.5 months? That's an enormous quick increase. The Fed has said they're only going to go to 4.6. Well, after months and months, Wall Street not believing that the Fed was going to actually follow through, now they're, no, they're going to go to 5. I don't think that's going to happen. The Fed doesn't want to jam on the brakes so hard as to tip the economy into a recession, which then forces them to reverse policy. Because in their view, I think it's correct that a brief, sharp recession isn't going to unwind labor market tightness sufficiently so that when we get to the next expansion, wage inflation doesn't ramp up early in that next expansion. So the Fed wants to get to a level that's modestly restrictive and hold it. But the market, after not believing the Fed's going to do what they're going to do, now is, they're going to do more. This is kind of what happens when you get to turning points. All right. I think between now Christmas, I think consumers, most people are going to want to have a nice Christmas. They're going to spend a little money. But as we get into the first quarter, I think we're going to see a more decided slowdown in the economy. And at some point in time, as the Fed approaches that terminal rate, in other words, the peak the Fed funds is going to be at, that's going to be, I think, supportive. Lastly, despite the huge run up from 399 in the 10-year to 433 on Friday. It didn't close at 43. That was intraday high. You can see the RSI is not making a higher high. It's making a lower high. So, and it had a pretty nice reversal. We'll see. Those are just nascent signs of potentially a little bit of a shift. And last but not least, okay, gold. I think a rally towards 1730 to 1760. Remember, it went from 1660 to 1728. I think that was an A wave. We pulled back to like 1618. So it potentially in an ABC up can take out that 1728 by a small amount. But I think potentially looking at this wave count from the high in August of 2020 at 2070, 1, 2, then wave 3 did a 1, 2, 3, 4, 5. We had that bounce to 1728. As I said, that might have been A of wave 4. The drop is B, go up towards that high again for C of 4, and we get one more drop under 1616, maybe towards 1560, 1580. And then I think the market has a pretty good rally. Again, as the Fed communicates that they're actually going to be shifting, it's not going to happen for a few months. That and the dollar then starts to transition from being super strong to going through a correction. I think that's going to be pretty helpful, for gold. Lastly, secular bear market. If you look at history, after a huge run up, valuations get crazy. Well, this January valuations were stupid high. And historically, then you go through an extended period, as this chart going back to 1870 shows, and they can last, roughly 15 years plus or minus a little bit. And I just put together a piece, The Coming Secular Bear Market. I discuss a lot of the points that are in there in detail as to these are some of the problems that are going to inhibit GDP growth. Over the next 15 years, GDP is going to grow less than 2%. If you look at labor market growth, productivity growth, and we've got a mountain of debt, and interest rates are not going to be as low. So interest expense is going to, if you will, squeeze out spending for other things. So there's a lot of things that are coming together that suggests to me that either we started the secular bear market with the top in January, or there's one more last hurrah to a new all-time high next year as the Fed shifts before this kicks in. The main point is everyone's been taught buy and hold, buy and hold. In recent weeks, they keep showing on CNBC, and I've seen it written, well, if you missed the 5 best days of every year for the last 40 years, your return would be this, which is terrible compared to just buying and holding. You know how good you'd have to be to miss the 5 best days every single year? I mean, that's like improbable. To me, it's disingenuous. I could go back and say, well, if you missed the 5 worst days, your return would be like off the charts. That's just complete baloney. So my point is, in a secular bull market, buy and hold, perfect. Secular bear market, buy and hold, especially for those 40, 50 years old. You're going to lose 15 years going sideways. 1966 to 1982, the market went sideways. And inflation was high, so it really eroded, if you will, the value of portfolios. So to me, one has to start to think ahead that, all right, somewhere along the line, incorporating a tactical approach for a portion of the portfolio, in other words, another layer of diversification, I think makes sense. So with that, I appreciate your time and attention. And if there's some questions, more than happy to answer them.
Very thoughtful and well-received presentation, my friend.
Great, glad to hear that.
Getting a lot of comments, that you explain things in terms that people could understand. Complete picture of market given by Jim Welsh, very professional person. Appreciate your efforts for the presentation. People want to buy your PowerPoint presentation. Well, they want it. Okay, Jim, people want to know where they could see it again. And of course, this is videotaped. And so
they'll have access to
great.
it that way.
Yeah. So any questions before Jim takes off to enjoy his Sunday from you guys? Brilliant.
Thank you.
Thank you, Jim. So informative, masterclass. So Jim, your work is appreciated. I know how much you've helped me over the years, and I recommend everyone send Jim an email and put this on your reading list. Of course, it doesn't come through the mail anymore, right, Jim?
No, it does not. Even for old guys like us, we've learned that,
I used to, I would
snail
wait
mail
by
is just not
I would
happening.
wait by the mailbox, buddy.
Well,
So
again, I appreciate those nice comments. Thank you very much. As I said at the beginning, thank you for tuning in. You're going to be glad you did 45 minutes later. So it's nice to hear those comments. And secondly, I know, given all the years I've been doing this, there are very few people who can combine the understanding of monetary policy, what's happening with the economy, and then incorporating technical analysis into how markets may or may not behave. I feel really good about, if you will, having come to this juncture with this toolbox.
great tactical stuff in Jim's writings.
Hey,
Yes.
hey, Jim, I just wanted to say, great to have you here. I always love meeting with you every week. But before you go, I actually had a question for you.
Me too.
well. Oh, Ryan does too.
Yeah, you go first, mate.
Okay. Hey, I want to ask Jim, how much emphasis do you put on positioning and sentiment? We know you look at the what is happening with the data and
Yes.
what's happening with the Fed, and you incorporate that into your analysis, and obviously your technical analysis. And I mean, you've probably been doing wave counts more than longer than some of these people, some of these listeners have been alive. But how do you incorporate sentiment and positioning?
Okay, that's part of the contrary opinion subject that I talked about. But one has to understand something. For instance, in a bull market where the Fed is neutral or slightly accommodative, and the market's been going up month after month, sentiment's going to get pretty bullish. But markets don't go down unless there's a reason to sell. Think about Wall Street is on the buy side. They want you to buy and hold forever. So in order to get anybody to sell, you need to hit them over the head with something like much tighter monetary policy. So when you get a window of time like we've seen where the Fed is tightening, the market's going down, sentiment gets really bearish. Oh, look at that, the AAII survey. But we've got a headwind going now with monetary policy. And what we haven't yet seen is the economy really showing signs of weakness, earnings coming down. So my point is, sentiment is really important. I track a lot of sentiment stuff, right? But one needs to then look at momentum indicators and technical analysis using charts and so forth to know when, all right, the underlying technicals are starting to break down. So last fall, sentiment was really bullish. And guess what? Dow or the S&P made a new high in January. The AD line didn't confirm. Classic topping signal. So to me, sentiment is wonderful. In a bull phase, you get any kind of modest pickup in negative sentiment, you usually got an intermediate bottom. In a bear market with Feds blowing hard against the market, you need to really incorporate technical analysis to identify when a trend change is going to happen because, hey, we're in a bear market.
Sounds great. Thanks, Jim, for addressing that. Ryan, you had a question for Jim?
Yeah, have you been surprised that the economy hasn't responded to all these rate hikes? I mean, it's been really, really, hard and fast. Has the economy just not had a real chance to catch up? And the longer that goes, is the damage going to be incrementally worse the longer that goes?
Okay, good question, Ryan. All right, so we know that coming into this year, consumers had more than $2 trillion worth in savings accumulated when they didn't go out and the government gave them a bunch of money. Granted, that was overweighted toward the upper incomes, but that gave them if you will, consumers a war chest to keep spending. The first quarter GDP down 1.6%. It was because trade was down 3.2%. So in other words, the way they calculate domestic GDP is if we buy stuff from overseas, we subtract that from domestic GDP. And so we bought all kinds of stuff from overseas. That's not a sign of weakness in weak demand. All right. So that gave everybody, oh my God, 1.6. In the second quarter, it was down 0.9, primarily because Target and Walmart and everybody started to adjust inventories. But if you look at what's going on with employment and wages, those are all the reasons why I did not think we're in a recession. And again, the labor market really reacts with a drag. So to your point, and this is again the Fed's consideration, they don't want to go so hard and fast by raising rates to cause a sharp deceleration that would cause them to prematurely shift policy. That's why I think they've chosen the course of we're going to get to a restrictive level and then keep it at that high level. So until we really start to see unemployment pick up, consumers have the money to keep spending, and that's going to keep the economy going. I think, as I said in the presentation, by mid next year would be the time frame that I would say that looking for a recession to actually begin seems more realistic.
And I have to say, Jim, you and I meet every week. We do a show together, and it's something that I really enjoy at the end of the week, every week on the Trader Summit site. And you were really the first by literally weeks that I can recall that said, hey, the Fed's going to front load rates that, as they started to hike, or before they start to hike, they're going to front load rate hikes and ratchet them up really quick. And they really did. So
yeah.
Kudos
well,
to
Jay
you.
Powell tipped his hand, Blake. He said, we're facing a severe threat. Well, how do you respond to a severe threat?
Yeah.
You respond aggressively. So to me, again, listening to the Fed can be really helpful. That forward guidance, in a sense, it can be a tool to use against markets, since most markets and participants don't have the length of experience with high inflation, monetary policy. They continue to, okay, I don't want to miss the next rally. Well, that has gotten them into trouble this year, and I don't think that trouble's ended.
Jim, we're getting a question. Any special arrangement that you have for people for your letter that are here at the summit that email you at that address?
I'll give you a 20% discount. So the weekly technical review goes out every single Monday, a combination of some fundamentals, a lot of technical, the monthly macro tides, a lot of fundamentals, looking at the bigger picture and so forth. So normally you get both of them for $500. I'll give you a 20% discount. You say you're from Trader Summit.
Jim Welsh, a consummate pro.
Thank you, Dale.
He is, isn't he?
Thank you. Coming from another pro, thank you very much.
From another old guy.
Yeah, I was sticking with old pro sounded better than old guy.
you have to have some years on you to be consummated anyway, right?
Not going to touch that one. Hey, thank you, guys.
Right, thank
I appreciate the opportunity
Jim.
to participate in the conference. I'm sure it was wonderful. Participants, I'm sure, learned a great deal from all the different speakers.
Nice job.
Dale almost got hit in the head with a cup of coffee by couldn't remember if it was Peter Schiff or Danny Blanchflower yesterday, but there were some things flying between the two that you might have missed, Jim. So.
I did hear about that, and I tell you this way, it's like I love music, right? But I'd get bored if I was listening to a song that only had one note repeated over and over and over. That summarizes Peter Schiff.
I know you've heard me play guitar, Jim. You don't have to bring it up here.
I'm not talking about playing the guitar. I would never play one note over and over again. But I know someone who does when it comes to financial and economic analysis.
Oh, yeah, 1.618. Anyway. Thank you, Jim. It was great. Guys. You really, I think, are going to help some people shape what their misconceptions might be at this time.
Well, cool. There's a secular bear market coming, folks. Got to get ready.